that we've looked at so far are businesses who are trying to make a profit. But what we're going to talk about now are not for profit organisations. So, the purpose of these organisations, as the name suggests, is not to try and make a profit, it's to do something else. Some sort of philanthropic goal or social goal, some sort of purpose that doesn't centre on making a profit. So, I'm sure you can think of lots of well known charities. And if you think about the reason that they exist, it's not to try and make money for anybody, it's to try and do some good in the world. So often charities will raise money through fundraising, through donations. They might also get some money from the government. They get their income in, and then obviously they have lots of costs for doing whatever it is they do. And the idea is that any money they have left over should be reinvested in that charity, should be used for whatever goals that charity is set up for. Charities do need to produce accounts, and there is a sort of specific format for how a set of charity accounts should look. Um, Usually, what you'll find is that charities are registered as companies. They don't have to be, you can have unincorporated charities, but the vast majority are incorporated. One of the main reasons for that is just to do with the practicalities of running a charity. If you set it up as a company, it then becomes a separate legal entity, which means that the charity itself can enter into contracts in its own name. So if the charity employs staff, you wouldn't really want those staff being employed by the people who are involved in running that charity. It's good if they can be employed by the charity in its own name. The same with any other contracts that they might enter into, such as renting premises or purchasing assets. So, if the charity is set up as a company, then usually what happens is that it's called a company limited by guarantee. So, a company limited by guarantee is owned by its members, but rather than putting the money into the company like you would when you purchase shares, they instead promise to contribute that money if the charity is ever wound up. So they guarantee that they will hand over their whatever nominal value it might be if that company were to be wound up. And it can be a small amount, often it's £1, that they commit to contributing in the event of winding up the charity. The charity itself is responsible for its own debts. Remember, it is a separate legal entity. And the charity is managed by its trustees. So the trustees would be the ones that decide how to run that charity. They might decide where to allocate the funding, which projects they're going to support, whatever day-to-day decisions need to be taken. If the charity is registered as a company, as I say, as most are, then the trustees will also be directors of the charity. Remember, directors are always the people that run a company. There is a separate piece of legislation called the Charities Act, which governs how charities are run. And there's an entity called the Charity Commission that oversee how those charities behave and what they are and are not allowed to do. You have to be registered with the Charity Commission if your income is over a certain threshold. You don't need to know the monetary amount. In terms of taxation, I wouldn't get too bogged down in this because it is quite a complex area and you're not going to be expected to know the details of how a charity is taxed. The main thing to know is that in most cases, the charity will be exempt from tax. So it usually wouldn't pay corporation tax, capital gains tax, VAT. Even if it is set up as a limited company and you'd be expecting it would usually pay corporation tax. Like I say, in most cases, I can't say in all cases, but in most cases it would be exempt. And that's as much as you need to know. Okay, So just to conclude this section, we have a lecture example. It's one of these true or false questions. Are the following statements true or false? So the first statement says there is no set format for the accounts of sole traders. So hopefully you know that that is true. Yeah, unlike a company that has to prepare its accounts in a set format, a sole trader can prepare those accounts in any way they like. The next statement, the liability of partners in a partnership is limited to the capital they have contributed to the business. Now, note that it says partnership, it doesn't say limited liability partnership. So that one is false. Remember that partners have unlimited liability for the debts of the partnership. It's only if you're an LLP or a company that you have that limited liability protection. The next statement says companies can enter into transactions in their own name. So that one is true because they are a separate legal entity. So that's correct if a company were to purchase assets or enter into a contract, employ staff, all of those things would be done in the company's name. Statement 4 says there is no regulation concerning how charities are run. So that one is false. A moment ago, I mentioned the Charities Commission and the Charities Act, both which impose responsibilities on charities and dictate certain things that they are and are not allowed to do. And then the final statement, LLPs must be registered with Companies House. So that one is true. And we had an earlier video, didn't we, on LLPs. And yeah, one of the features was that when they're formed, they need to be registered with Companies House. In this section, we're going to be talking about the tax implications of different business types. Now, this is always a tricky area because the word tax can actually mean lots of different things. There's loads of different taxes that are used by the government to raise money. So it could be income tax, corporation tax, value added tax, VAT, the different employment taxes. It might even be other ones that you might have heard of that aren't specifically in your syllabus. Capital gains tax, inheritance tax, for example. There's so many different taxes that what I really want to stress is that at this level, you're not expected to know how any of the taxes work. So you're not going to need to do any detailed calculations. You're not going to need to know any specific rules about those taxes. That will all come later in your studies. What you need is just a high-level overview of which taxes are relevant in different scenarios. So the first thing we're going to talk about is how the government taxes the entity if it makes a profit. So starting off with our sole trader. The sole trader will be filing a self-assessment tax return each year. And on that tax return, they will list out all of the income that they've earned, all of the allowable expenses that they've incurred, and that will come down to a profit figure. Now, that sole trader personally will be paying income tax on the profit that that business has made. Next, we'll look at partnerships and LLPs, and we've included these together because they're both taxed in the same way. The partnership itself is going to file a tax return, and on that partnership tax return, you will have the partnership's income and allowable expenses and the overall profit figure of the partnership. And then what will happen is that each individual partner will file a self-assessment tax return, just like our sole trader did. And that will include on there their share of that overall total partnership profit figure. Now, the purpose of the partnership tax return is to get that total figure, but the partnership itself doesn't pay any tax. It's then when that's allocated out to all the individual partners' tax returns that they personally pay income tax on their share of those profits. Okay, so that's important. The partnership itself or the LLP itself is not paying tax. We just do a tax return to show the total overall profit figure. And then what should happen is that when we add up all of the profit figures that those individual partners have put on their tax returns, that will reconcile back to that total. And it's those individual partners who pay the income tax on their share of the profits. It's different with companies. So companies pay a different type of tax called corporation tax. So they will calculate their profit figure and the company itself will pay corporation tax on that profit figure. And then what happens is that, assuming the company has made a profit, it might decide it's going to pay that profit out to the shareholders as a dividend. Now, if that happens, if there is a distribution of profits, then the shareholders, who will also be filing a self-assessment tax return, will include those dividends as income on their individual tax returns. And they will pay income tax on the dividends they've received. So there's two types of tax that are relevant there. Company itself, corporation tax on the total profits. If the company then decides, and it'd be the directors who would decide whether to pay that profit out as a dividend, if that happens, the individual shareholders who receive that dividend would declare them on their self-assessment tax return and pay income tax on that amount. Okay. What happens if the entity employs staff? Well, as you can see by this sort of merged cell across the table, it doesn't matter how the business is structured. It doesn't matter if it's a sole trader, a partnership, an LLP, or a company. Regardless of structure, if you're employing staff, you will need to run payroll. And when you're running that payroll, what that involves is collecting in any relevant amounts, so PAYE, employees' national insurance from staff, and paying that over to HMRC, along with any of our own taxes that we incur, such as employers' national insurance. So if you think about your own pay slip, if you go and have a little look at that, you'll see listed on there PAYE, which is income tax, PAYE, which you have suffered yourself, and employees' national insurance, which you have suffered yourself. That amount is paid over to HMRC by your employer on your behalf. But what you might also see listed on your payslip is employers' national insurance, and that's not been taken from you. That's an amount that your employer has had to pay to HMRC as a sort of tax for employing you. So 3 different types of taxes that are involved when we run payroll, and the type of business structure makes no difference to that. And it also makes no difference to the last one, which is what happens if our turnover figure exceeds the VAT registration threshold. So there's a certain monetary amount, you don't need to know what the figure is. And if your turnover, if your revenue goes over that amount, you have to be VAT registered. It doesn't matter whether you're a sole trader, partnership, LLP, or company. Once you go over that threshold, you will need to be VAT registered. Once VAT registered, all of your sales will need to have VAT added onto them. You'll need to submit VAT returns to HMRC. And by doing so, you will be able to claim the VAT back on any allowable expenses that you've incurred in the business. Okay. So it's the profit one really where it makes a difference as the type of business structure. With the other two, obviously, you need to have an awareness of the fact that the taxes are going to be incurred, but the business structure type isn't going to make any difference to that situation.
Okay, having seen the idea of the separate entity concept, sole traders, partnerships, limited companies, and not for profit organisations, we're now going to focus on the advantages and disadvantages of a limited company. Remember, with a limited company, if it has the abbreviation LTD or the word limited after its name, then it's a private limited company. If it has the abbreviation PLC, it is a public limited company. Now, there are additional legal requirements and costs involved in running a limited company, but there are also benefits. Let's have a look at these. The biggest benefit of trading as a limited company is that individuals have limited liability status. This means that the owners, also called the shareholders, the members of the business, will only lose a maximum of the investments they have made in the company should it fail. They cannot be personally held liable for the debts of the company. So if I purchased one share in a limited company and this cost me £1 and I've fully paid that pound, if the business entity fails, then you only stand to lose that £1 investment. You won't be asked and you won't be required to bail out any company losses or shortfalls. Your personal assets are secure. And this is the idea behind the separate legal entity. Any losses are the responsibility of the company itself. With a limited company, another benefit is that it's easier to raise finance. A limited company can have greater access to funding through the issuance of shares. Now, remember, shares are where an organisation will have multiple owners, where the organisation sells portions of the business to them. It's also easier to raise finance through other securities, for example, loans. And this really stems back to the professional status of being a limited company. There's a better image and you're held in a much higher regard. Even though your activities, your structure, and your management may be the same as perhaps for a sole trader or a partnership. It links to the ease of raising finance and attracting new investors and customers. Another advantage is that the company will continue to operate regardless of the ownership. So think here about a sole trader business. We've spoken about a butcher or a barber. And these types of sole trader businesses will be owned and managed by that person. Should they retire or perhaps unfortunately pass away, the business will cease because their skills, their knowledge, their expertise is actually taken away with them. But with a company can continue. You have multiple owners in the form of shareholders, and you'll also have a board of directors who are responsible for running the business. Another advantage is that you're taxed under corporation tax. Now, this doesn't sound like much of a benefit being taxed. However, the rates are currently lower compared to income tax. Currently in the UK, the corporation tax rate is 19%. It's higher for income tax. And as an individual, if you have a sole trader business, you not only pay income tax, but you pay national insurance as well. So there are benefits of becoming a limited liability company. If you are of a certain size, your corporation tax will become less than income tax paid for sole traders. A few of the disadvantages of trading as a limited company are listed further down the page. Company accounts do have to be submitted at Company House, so there's more regulation surrounding limited companies, and also there's more public visibility because anyone can access company accounts. You're in the public eye. Your personal information will also be in the public eye. This compares to our sole traders and our partnerships, which are not in the public domain. Under the Companies Act 2006, there's also more regulation to comply with. It places restrictions on what the business can actually do and how it's got to be managed, as well as placing additional reporting regulation on the company. So it's more complex and it's more time consuming. Companies have to file an annual confirmation statement, and this has to be filed at Companies House. They have tax returns, annual accounts which have to be filed, and minutes of meetings have to be recorded as well. Accounts of larger companies, usually PLCs, have to be audited, and this is performed by an external auditor. It involves checking that the business is being run properly and that the financial statements that have been prepared are accurate. The aim of an external auditor is to conclude if the accounts are true and fair and correct, giving a true and fair picture of the company affairs. And what they're doing here, the external auditors are reporting to the shareholders, the owners of the company. This business is being run in a true and fair manner. The accounts represent a true and fair status. So, really, a big cost involved here. The final drawback we've got is that issues of shares are highly regulated. It's regulated by the Companies Act 2006. So although there is greater access to financing, it is very heavily controlled and monitored, both regarding the allotment of shares, how they're divvied up, and the issuing of shares. Let's now look at lecture example 2 about a limited company. Phil is looking to set up a new business selling cars, and he's trying to decide whether to set it up as a sole trader or a limited company, but is actually unsure what the differences are. What we need to do here is draft an email to Phil explaining what the main differences are between the two types of business. So we have the format of an email in our notes here, and it's addressed to phil@businessunknown.co.uk. And we are an accountant, so from an accountant. The date, we're not given a formal date, so we'll just say today. And the subject is what we're talking about. And here we're talking about different types of business. And this would suffice as your email header in your real exam. Okay, so we need to address who we're writing to. So, Dear Phil. And in the real exam, what you'd do is you would structure your answer in a logical way. You would answer the question that has been set. You would use full sentences and good, appropriate language for the person you're writing to. Include no abbreviations, no slang. You really need to think about who it is you're writing to. Now, for simplicity purposes here, we're going to write a few notes to help us write the answer. After the recording, it might be a good idea to go away and attempt to write this out in full. So you would start with an introduction, and then you would go into the main body of your report. And what we're looking to do here is to state the differences between a sole trader and a limited company. So remember, we are just drafting notes here, ready for you to write this out in full. So, starting with a sole trader, there is no distinction between the individual and the business. A sole trader is a single individual, a one-man band. And what they've done is they've set up the business, they own the business, and they run the business. There is no separate legal entity, so for a sole trader, unfortunately, they are fully liable for any debts of the business. What they could end up doing is lose personal possessions. So, quite risky. One benefit of being a sole trader is there is no set format for accounts. And regarding taxation, they're taxed on income personally. So a few notes there on a sole trader. In comparison to this, a limited company does have a separate legal identity. Individuals have limited liability. Which means individuals are only liable for the money put into the business.